The following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
We are on KLFE, the answer about money. You know, tariffs and trade and NAFTA and China. What's it all mean for investments? We're going to be talking about that. You know, I can remember a time when there would be just enough news that I could take a topic and talk about it for almost 2 weeks. Nowadays, it seems like there's so much information to talk about. There's not enough time in a 1-hour program to talk about it. But we're going to talk about trade and tariffs and NAFTA and China. We're going to get to all that today and talk about what it means in terms of investments. We're going to talk about the help wanted signs. You see those everywhere. What's it mean for business? What's it mean for investments? We're going to get to that too. But I want to start with a conference, because every year I go to a few conferences, and one in particular that I go to, the Money Show. I'm there with like 1,200 of my best friends. I mean, it's a huge conference. The attendance of this year seemed to be down. I think that there were closer to 2,000 last year. This year, about 1,200. Last year was a time in which was the first year of the Trump administration, and the audience was generally very optimistic. Prior to that, during the Obama administration, the audience tended to be pretty pessimistic. They tended to think that the market was going to go down by the end of the year. And that happened year after year after year as I went to this conference. Now it seems that they're very optimistic and that they think the market's going to go up and up and up. Same thing happened this year. There was a lot of optimism. Maybe not quite so much, but there was a lot of optimism. There was more concern about a recession coming. Maybe it was because of the age of the bull market. You know, we've been going since 2009. And the Fed has been increasing interest rates. There's talk of a trade war. Actually, there was no talk of the trade war during the conference. I talk about the trade war, but they didn't. But there was an uneasy feeling. You can feel it from a number of the speakers, a number of the people who were in discussion groups. You can feel that there was some tension. Most of the time, when I've gone to the show, I've had a lot of disagreements with the speakers. This time I had a lot fewer. The first day during the general session, Robert Eisenweiss, the vice chairman of Cumberland Advisors, talked, and he talked about the first quarter GDP was 2.4%, down from the Trump target of 3%, but it was still moving along in a positive direction. The tax break that was supposed to stimulate the economy, we talked about that because it was supposed to give consumers or give stimulus to the economy. It was not happening. You know, my guess is that oil prices are up and it's probably not going to happen. Jobs, we talked about jobs creation. And when you look at the jobs picture, in the 1960s, we were creating about 4 times as many jobs as we're creating today. Even in 1983, twice as many. So we were talking about the economy, and my guess is it's going to be more difficult for job creation as we go forward. By 2022, in less than 4 years, 35% of the labor force is going to be over 50 years of age. By 2030, 20% of Americans are going to be over 65, which is around the normal age of retirement. And the skilled positions are going to be the ones hit most. There's a lot of talk about 1/3 of the workforce, almost 1/2 of the workforce are millennials, but very little talk about what's happening to the aging population. And we are getting older, and we're seeing some of that impact. It's probably going to get worse before it gets better. You know, we talked about interest and inflation. The Fed is raising interest rates, probably going to raise a couple more times this year. Oil is up almost 50% from where it was a year ago. Commodities are increasing in prices. Wage rates, we're beginning to see increases there. All of those are an indication of inflation returning. Not intensive inflation, but a gradual pickup of inflation. I've been talking about that for a couple years now, that we will probably continue to see a gradual increase of inflation as we go along. And we talked about that sometime. We talked more about the tax cut because the idea was it was supposed to stimulate capital spending by companies, and that in turn would result in more jobs. But what has not been seen is there's been no real increase in capital spending. The tax cut didn't have the impact in capital spending it was supposed to have. There have been some bonuses that have been paid, but probably less than 5% of the tax cut has been paid out in bonuses. More appropriately, there have been a lot of share buybacks and a lot of money that simply fell to the bottom line to increase profits. My take as I looked at the beginning of this year, I talked about the tax cut and I talked about the way that most companies would probably use it as increasing their bottom line. That seems to be happening. And that was something that was not supposed to happen. That money was supposed to be spent. It was supposed to stimulate the economy. That's not been happening. The tax cut was also something that immediately was supposed to give consumers more money in their pocket. The idea was the consumers were going to go out and spend that money, increase demand, which would further spur capital investment. Several companies who track consumer spending have not seen any real increase in consumer spending. The share buybacks are the big thing that people are talking about. And a lot of people are saying it's removing shares from the market, it's not doing anything. So when I got my MBA at Carnegie Mellon. And at Carnegie Mellon, Mogliani and Miller were at Carnegie Mellon before they left for Chicago. And when I got there, there was talk about the capital asset pricing model. That was developed by Mogliani and Miller. And it makes sense in terms of the share buybacks. When you talk about the price-earnings ratio, and a lot of people talk about the price-earnings ratio of stocks and looking at stocks, and growth stocks have a higher price-earnings ratio than consumer stocks that are growing more slowly and so on. But if you turn that ratio upside down, if you look at the earnings per price, it gives you something like how much earnings companies are earning for every share. So if they are earning $2 and their stock price is $20 a share, that's a 10% earnings per share. If it's $30, it's about 6.7%. Well, if you look at that, right now, the earnings per share on the average for most companies, on the average for the Standard & Poor's 500, it's about 6.5%. Companies can borrow at 4%. So think about that. For every share they've got issued, they're earning about 6.5%. But they can go out and borrow money at 4%. So it makes sense to go ahead and borrow at 4% to recover that 6.5%. That's part of the asset pricing model. The Mogliani and Miller said it's logical for companies to go out and buy back their stock when they can do it, when the earnings per share are better, the earnings per price per share are better than what you can borrow money for. And that's what's happening. That's how a lot of corporations have looked at it in terms of their earnings. They look at their earnings, which actually got a boost and a kick because of the tax break. And so they use some extra money that they're earning to go out and buy their shares back, which in turn increases the value of the remaining stock. So they're removing shares, they're increasing the price and earnings ratio, and they're making companies use the money in many ways, according to the capital asset pricing model, more efficiently. You know, my take on the whole thing is that early in the year, my outlook was that we were going to be very good for stocks. The tax cut would improve earnings to companies. And when you look at the year over year first quarter earnings, they were up about 24%. The average is around 9 to 11%. This year, up 24%. And stocks are driven by earnings. We haven't seen that in the average of the Standard & Poor's, which is basically flat for the year. But eventually, that's going to kick in. That was my thought at the beginning of the year. It seems to be panning out. That seems to be where we're headed. The Case-Shiller model, which there was a discussion about, Case-Shiller came out with a lot of information about the housing crisis. Now they've applied that to the stock market. Most people that are stock pickers and in that kind of market don't really believe that the Case-Shiller model is accurate and efficient. I tend to agree with them. That was a discussion as well. So in the past years, I disagreed with a lot of what's been said. But this year, I agreed with quite a bit that was said. There's still that nervousness that permeated that entire session. I have less nervousness. I tend to be optimistic in general, but I tend to be very optimistic about this year because if you look at the earnings being up 24%, that's very significant. And yes, there could be some problems in the future. There could be some clouds, and we're going to talk about one of those later in the program with tax and tariffs. We'll be talking about that. Don't go away. Got a lot more to come. And I've got a great guest today who's got a great story to tell. Don't go away. Stay with
money
me.
Coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the money show that I went to a few weeks ago, talking about the general attitude of things. About 1,200 attendees, a number of speakers. A lot of nervousness, a lot of optimism, significant optimism, not quite as optimistic, I think, as last year, but still optimistic, but a lot of nervousness. And I think if you look at it, since 1977, there have been declines of 10% or more in 25 of 41 years. So I think people have looked at what's been going on. Since 2009, we have not had that kind of a decline. And I think maybe the best summary was to look at what Jim Stack, who of Stack Financial Management, had to say. He said, this has been almost the longest bull market in history. Usually bull markets last 2 to 5 years. Now, he was talking about 2 to 5 years without a recession, breaking up the bull market. If you look at 1982 to 2000, I believe that's a secular bull market where the Dow went from 1,000 to 10,000. I consider that one period of time. Consider that we're in one period of time right now, 2009 to 2030 or however long it lasts, maybe 2025, but I think that we're in a long bull market. But he's looking at very short time periods, looking at 2 to 5 years. And he said that there were a significant number of nervous people. Since 2009, we've been approaching almost 10 years of this bull market. And I wondered, as I listened to a number of the speakers, if they haven't lost clients. I've heard so many stories of hand-holding during the Great Recession. I had like one call every quarter, and most of my calls were from clients who wanted to know if I was doing okay. They weren't worried about their financial situation because we're taking care of that. Most financial planners going into 2008, 2009 had done their asset allocations, which were supposed to reduce risk, and in fact didn't. But it did reduce the recovery. It went down just as fast as the stock market did, but it took a long time to recover. I look at my client accounts. My accounts were at new highs by 2010, but many didn't recover until 2013 or 2012. And I wonder how many of the people that were so pessimistic or concerned or nervous have been losing clients. Could be completely wrong. For me, I believe that John Templeton was right. Bull markets are born on pessimism, and he's talking about secular bull markets. They grow on skepticism, secular bull markets mature on optimism and they die on euphemism. We haven't seen that period of euphemism. We're just somewhere between the skepticism and the optimism. And maybe going to this conference, I got more skepticism than optimism. And as I talked in this conference, as I listened to people, it seemed like there's two groups of people. There's people who believed that everything that Obama did was right and everything that Trump does is wrong. And conversely, there's people that believe everything Obama did was wrong and everything Trump did is right. For me, I'm a mathematician. I'm a numbers guy. For me, looking at the people who were attending were primarily from the Trump side. And the thing that I was really surprised about is no one really talked about the trade war potential. There was only one comment that was made about the trade war, and that was that the buyer has the leverage and the U.S. is the buyer. We'll see if that's true. I want to talk about that later in the program. I don't know that that's really true. I wish it were. But when you look at what's going on with negotiations, we're going to get to that. In 2002, we went through a tariff and a trade war, and we saw some of the impacts. The fact is, we're seeing some of the leftovers from the trade war, even at this time, with the steel companies asking for relief. Anyway, coming back to the money show, there was also discussion of some of the long-term trends, which I think is really crucial and really important to understand in terms of where we're headed in this economy. The demographics, there's a growth of wealth. The world GDP in 2020 is expected to be $47 trillion. $31 trillion is expected to come from the developed countries, the U.S. and the European Union. $16 trillion from emerging countries. And that's largely new. I've been talking about the supercycle since 2011. The forecast is coming in now that by 2020, those developing countries are going to be 1/3 of the world GPA. That's very significant. From less than 2 or 3% to 30%. That's something that's very significant in terms of investments and investments. Second trend we talked about was scarcity. There's going to be scarcity of things like water and money maybe. Those are things which present some investment opportunities. In terms of medicine information, wearable technology, biotechnology, drug development, and for me, it's not just medicine. I believe that bioengineering is going to come into a significant play. We've seen that with some of the companies that have been on here. I blew marble on. They took the bacteria from the stomach of a whale and combined it with the bacteria of the stomach of a cow, and they're taking and creating petroleum products, replacement petroleum products, using the bacteria. Bacteria took 1 million years to make oil. They're now using bacteria to create it in a matter of days. We're going to see more bioengineering happening. Another trend is energy. A couple years ago, I talked about Mary Berry, the head of GM and the head of OPEC, who said that they weren't really concerned about electric cars because by 2040, only 1% of cars that would be sold would be electric. I came on the radio program the week that I heard that and talked about it and said I'd be surprised if it wasn't 25%. I think today people are talking about the death of the internal combustion engine. I believe that's true. Energy is making a change. We're going to see autonomous cars. We're going to see renewable energy, regardless of what China does with their subsidies for solar. Regardless of all that, we're seeing a focus on renewable energy because as you get GDP growth, you have a greater and greater requirement for energy. And we're seeing that people are focusing on renewable energy, and it's becoming economically viable with oil and the other sources of energy. Another long-term trend is technology. Anything that enables productivity, gathering information, anything that can be automated will be automated. We're going to see artificial intelligence spread to a greater extent. And the final trend is one that's not very nice, but it's war and terrorism and ugliness. You know, if you look at the world right now, it's divided into two camps, maybe three. Two camps were discussed, the U.S. and Russia, but I believe that China will come into play. So the world will probably be divided into three camps, U.S., Russia, and China. And I think that Europe supplies some arms, but they will probably still continue to be aligned with us. If you look at what's happened militarily, we reached a peak of conflicts in 1989, and the number of military conflicts has been decreasing since then. Not every year, but if you look at the long-term trend, the number of military conflicts has been decreasing. I believe that's going to continue to be, but still, there's an investment trend that's going to be there. So the other, those are things to think about in terms of investing. Those are the long-term trends. I believe those are the ones. But there was another thing that was discussed during that session. It was value investing. And there were a couple value managers at the conference. And when I was getting started, when I was cold calling, I had called a guy that had a long list of stocks. I remember this. He had one stock after another. He started naming off stocks, and we didn't even get through the phone call before it was finished, and he hadn't finished naming all the stocks. I thought, this is a huge investor. So I went to see him and talked to him about his portfolio. And what I discovered is from the 1920s, he had started to buy one or two shares of stock, and he still kept all those stocks. One or two shares that split a number of times, and there were hundreds of shares then. That was a buy and hold. Today we know that buy and hold doesn't work, but I don't believe that value stocks work either. And that seemed to come through as well. All those things from the conference. That's where I went. That's what happened. When you look at what's happened, Richard Foster of Yale did a study, found that companies that were part of the S&P 500 in 1920 had a 70-year life. Today, companies that are part of the S&P 500 have probably a 15-year life. And I don't know if it's 15 or 20, but it's going to be a much shorter period of time that they exist. When you're talking about value stocks, when you're talking about buying low book value or low price to earnings, a number of those, a lot of those are companies that are on their deathbed. And if they're not on their deathbed, they're in the nursing home. They are needing assistance. Those are companies that have not made the transition to the new economies. They're being put out of business by disruptive technology. And those are the companies which in the old days, a few years ago, were value companies. Today, value investing in the traditional form has underperformed for at least 5 years. And my guess is value investing is taking a whole different change. And to do real investing is not the typical value investing. We're coming to a commercial break. Don't go away, because right after the commercial break, I have an interview of a guest who's got a tremendous story to tell. So don't go away. I'll be right back after this. Stay with me. We've got a lot to cover.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, we're back on the radio. It's Friday. We're at KLFE, The Answer, and we're talking about money. But I want to introduce my guest today, Beto Yarsi, if I said that correctly. Welcome to the program.
Yeah, thank you. That's correct. And thank you, Mike, for inviting me. I'm very excited to be here.
So, Pedro, let's start with your background.
Sure. I'm originally from Mexico, from Guadalajara. I moved 15 years ago to Seattle, and I started my business right away after I moved from Mexico with only $250 selling jewelry at Fremont Sunday Market. It was a great experience, but it was a little hard to navigate the system and really understand what do you need in order to build your business. Very quickly after 5 years, I was very established and financial stable on my business. So I started volunteering and sharing my experience as an immigrant to other communities of color and underserved communities of how they can start their business. I did that kind of like for a year, and then after that, I get invited to be part of the work that I do today, which is ventures, and create the whole Latino program for them, and basically like a program that help them to get out of poverty and move their business. It's in Spanish. So that's basically like my background and how I always been an entrepreneur since I'm 8 years old. I started my first business at that time with my mom taught me break-even point with a box of chocolate. So I've been very, very fortunate to have that mentorship and help.
So let's talk about Ventures. That's the name of the company. That's the name of the It's actually a nonprofit, correct?
Yeah, we are a nonprofit, a 501c3, a CDF5, a Community Development Financial Institution. We've been in business for 23 years, so we were founded in 1995. And we start just access to microlending. So microlending is very popular in undeveloped countries. So our founder, Peter Rose, went to Bangladesh and he really liked the model over there. And he came back to Seattle and he wanted to implement that. So very quickly we find out that our clients they want to serve here in Seattle and the Puget Sound need more than just access to capital to move out of poverty. They need a lot of support. So we create what we have today, which we have business developing training program, technical assistance, incubation, ongoing support, and access to capital. So that's what Ventures does to support these communities of color, low income, and to help them to move out of poverty by micro enterprise.
So let's talk a little bit about the people that would be using Ventures. What's the demographic?
Yeah, clients of us, they are like low income based on the federal guidelines of what that define like a family of three making less than $23,000. So that in the King County, which is like very challenging for people, but sometimes we don't think that people can live with that, but it's happening. So that's the population that we serve. 75% of our clients are people of color. 70% are women. 40% are immigrants and refugees, and 100% low income. So our clients are people who have really good ideas. They are already running their business. Some of them, they have the dream to run a business, but unfortunately they don't have the privilege or the support that I have myself, that I have my mom taught me, or my dad were my mentors of entrepreneurship. So that's what Ventures really invest in these clients, because our goal is to move and alleviate people out of poverty.
So you talked about micro investing, but it's a lot more than just the investing, right? More than just the access to some capital.
Yeah, it's a really good question, because so many times we hear that small business, the only challenge that they have is access to capital, and that's not what our clients face. Our clients really, it's a challenge, it's one of the components of the ecosystem. But I think we find out that what they really, really need is like the other support, what I just mentioned. Technical assistant, the business developing training program, how are you going to put together your business plan on marketing, financials, and operations? How are you going to, if you have any questions about any legal issues, if you really want to understand what is your relationship with money, we have a financial management training program for 16 weeks. If you want to create a marketing plan, we do have an 8-week program for that. We do have ongoing support with coaches, specialists who are expertise in retail, food, and services. And align all that, we have the incubators that they are not only an incubator. So sometimes people say, what is an incubator? So an incubator in business is like a term that you use to really keep a business in a really good environment. In that way, that business can grow. One of our incubators is
Let's,
located.
before we get there,
Yeah,
let's take a step back.
sure.
How do people hear about you? How do people become involved?
Yeah, that's also a really good question. We don't really have to do any outreach these days because a lot of our clients do word of mouth because we've been in business for 23 years and we have a very high success rate. Just to give you an idea, 68% of our clients move out of poverty after 18 months. So that means that they don't depend on the public assistance. That's very huge. So our clients recommend our program constantly to some of their communities, or they're just like we have a really good awareness out there. Of course, we do have partners and other nonprofits, government, that they refer constantly to our organization.
So once somebody comes, how do they get started? Do they go to a conference? Do they?
Yeah. So our program, it started with an orientation. That orientation is free for the community. People sign up, and we cover very basic things about business, but also who we are as an organization to make sure that people understand that we're a nonprofit. And then we exist because we really want to move people out of poverty. And after that orientation, people will have an interview with some of the ventures team, and then people will get access to the next step, which is a 8-week program, the business basic course. We cover marketing, financials, and operations. And based on that, after people graduate from their graduation, people have access to advanced services, which is the technical assistant, the coaching, the financial management training programs, the marketing, the legal, the incubators. So we have 3 incubators. One of them is Pike Place Market. So we have a retail store called Ventures Marketplace. I encourage people to go and shop and support small business. We're on the 5th floor on the mezzanine level at the famous Pike Place Market. So we have about 75 clients incubating their product, from jewelry, art, photography, packaged food, etc. And it's not only an incubator, but also it's a program. We give them feedback about the cost of goods, packaging, marketing, how they can grow their business on the retail and on the wholesale. We have similar with the food industry. We have access to commercial kitchen, a cost of now per hour for a commercial kitchen rent. It's like $70. And we just charge $10 because it's a subsidized. In that way, people can start cooking their food in a commercial kitchen and then they can sell it. We serve about kind of like farmers market stands, catering, packaged food, people who want to package their sauce, food trucks. And then we have the third incubator. There is a service incubator. We have a directory online that people can go to our website, and they can get access to all these clients that we serve on the service industry: construction, remodeling, landscaping, healing arts, Spanish immersion, consulting about marketing, business coach. And then you can just find all the list of clients that we serve, and then you can hire kind of like an Angie's List for good. And we go back to the capital. That's how we started, because the whole ecosystem, after people get support with all that, people can get access to capital.
So when you say access to capital, the loans are in what range?
Yeah, from 1,000 to 50,000. So 50,000 is our cap. That's kind of what we have to lend. And
the average loan?
It's about $5,000 in 2017. We will have a very different number in 2018 because we've seen a lot of activity. I'm very proud of that. So people are really coming and asking for larger loans, and that's very exciting. So we are not on the industry of lending, so it's not where we make our money. Our goal is to really help our clients to become financially stabilized, and then they are capable to start access to capital in different institutions. They start with us because they don't have collateral, they don't have credit. Some of them, they've been in very challenging situations like bankruptcy or things like that. So nobody will loan them money, but they have really good ideas and they have really strong business plans. So we need to believe on them.
And what was the payback ratio from last year?
100%.
100%. met their loan payments.
Exactly, which is fascinating if you see the population that we serve, the high-risk loans that we offer to these individuals. So I have a loan committee who is the fiduciary, and it starts with the board. We have a board of directors, and those half of them, they are bankers, and they always come and joke about like, I'm so jealous about your repayment rate. And again, this is because we do really invest on our clients. We really give them a lot of assistance and a lot of support to make sure that they feel empowered.
So tell people where they can find your stores.
Yeah, so we have our store at Pike Place Market on the 5th floor on the mezzanine level. So if people know where they threw the fish, the famous show. So it's a stairs right there. You just take down and then turn to the right. And we're just right there by the candy store and the polish store. And then it's like a beautiful store called Ventures Marketplace on the 5th floor. They can also find us online. So all the information is online, and it's venturesnonprofit.org. So very simple, like venturesnonprofit.org.
Perfect. Thanks.
Thank you very much. Thank you very much.
Stay with us. We got more to come.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So one of the things that very few people are talking about, or they talk about in limited terms, and especially our government, is not talking about moving closer and closer to an all-out trade war. You know, the economy is moving along. The economy's not reaching the goals that the Trump administration had put at 3% to 4%, but it's still moving along. The stock market since 2009 has quadrupled, almost quadrupled. The U.S. economy is $19 trillion, but we export $5.3 trillion. So about 25% of the U.S. economy are exports. And if you look at what's going on, NAFTA was supposed to be, we withdrew from NAFTA. It was supposed to only take a few months to get renegotiated. It's taken a much longer time. I've talked about that several times during this. Mexico and Canada are two big trading partners. Woodrow Wilson International Center for Scholars says that if we don't sign NAFTA, if it just goes away, we'll probably lose 5 million U.S. jobs. If you look at the jobs report that came in, we're creating 200,000 net jobs on the average, 250,000. That means 20 months of jobs gone from the economy. If you look, we're starting to see the impact already of the steel and aluminum tariffs. Mexico slapped a tariff on apples, along with other things. 25% of the Washington state apple crop goes to Mexico. Now, it won't destroy 100% of the demand, but it's certainly going to take some of the demand. And certainly they're going to look to other countries to supply some of those apples and some of the other products. In total, Mexico buys $243 billion worth of U.S. products. Yes, they run a deficit of $70 billion, but if you begin to tax that $243 billion, begin to apply tariffs to it, and begin to reduce that, that's going to have an impact. Canada does $342 billion with the U.S., and we actually run a surplus with Canada of about $8 billion. They're now going to apply tariffs to the steel and aluminum that comes back from Canada into the U.S. They could be do other things. You know, already China has heard from Brazil and Argentina that are already negotiating to replace the U.S. supply of soy, of rice, of pork, and a couple other products. And wheat. Wheat would affect the state of Washington. You know, it's free trade has been something that has been a long, difficult thing to do. You know, China doesn't want a trade war. They offered to cut $50 billion or buy $50 billion more. Actually, China could easily buy $200 billion more that the the Trump administration wants. But the big question is not the amount of product, not the trade deficit that we have. The big question has always been intellectual property. China doesn't want to give up where they are. There was something started by the Commerce Secretary in the Obama administration, and now it's Wilbur Ross in the Trump administration, both saying the same thing. The claim is that China makes it harder for foreign firms to innovate by squeezing their returns. The Chinese companies start putting out product at lower prices, and that squeezes returns. And I'm a numbers guy. I want to look at the numbers. Is it really true? And there's data I acquired from The Economist magazine, which seems to indicate the opposite. Studies show that instead of stifling innovation, it improves innovation. They looked at Europe and the companies in the European Union competing with Chinese companies, and what they found is those companies that were competing with Chinese companies actually began to increase their innovation. They shifted jobs to more advanced firms, and 15% were upgrading their technology in order to improve their competitive position. It didn't decrease in innovation, it increased. And there's a study showing that American companies have increased, those companies that are competing with Chinese companies have increased their R&D spending to compete with the Chinese competitors. The number of high-quality patents issued by American companies has increased sharply from 2010 to 2014. And some of that, or a good portion, is due to the increased competition. We're shifting away from also-ran companies to the new leaders, the new leading companies. The older companies that are dying are not making that transition, but the new companies with the new technologies who are competing with the new Chinese companies are indeed innovating. It changes the structure of investments. But this whole thought that the Chinese companies are competing in such a way as it puts American companies or European companies at a disadvantage, the data and the numbers don't show that. They show almost exactly the reverse, that the additional competition is driving greater innovation, is driving more competitiveness, more efficiency. That is a plus, a big plus. But if you look at what's going on, if we get into a kind of trade war where we use trade, we're going to come back to where we were. In my opinion, we're going to come back to where we were with the steel industry. The U.S. dominated the steel markets from the early 1900s through the 1970s and 80s. Instead of innovating, those companies wanted tariffs. Instead of improving their technology, they got tariffs applied to foreign competitors, foreign suppliers of steel. And the consequence is that the foreign competitors innovated. Our steel companies did not innovate. And we don't dominate the steel market worldwide anymore. We lost that leadership. That's the risk of a trade war. That changes the structure of investments. When you begin to look at investment portfolios, it's got to be used to compensate in the event that there is an all-out trade war. I hope there isn't. I really desperately hope there isn't, because I think it's a very big negative for the economy. It increases prices of imported goods, which drives up inflation. It makes companies here less focused on competing. They tend to become more relaxed about what they're doing. But it also costs jobs here and jobs in the other countries. Our exports begin to dwindle down. That gets more jobs here. So the whole impact is negative. So it's a matter of building portfolios expecting a trade war. Prepare for the worst, hope for the best. That's the way portfolios need to be structured to survive this. That's what I've been doing for the last year and a half in my client portfolios. Preparing for the worst, hoping for the best. If the trade wars don't happen, If that never comes to pass, we're still in a good position. If they do come, we're prepared. That's how you need to focus your investments and where you need to look for things going on. Demographics have to play. If you look at what's going on, help wanted signs by 2022, 35% of workers are going to be over 50 years of age. By 2030, 25% of Americans are going to be over the age of 65. That too is factoring in how you do investments. Skilled occupations are going to be more vulnerable. You've got to look at robotics, information technology, information intelligence, artificial intelligence, labor saving. All that's going to be built into your investment portfolios as well. Look for the disruptive technologies. Look for the disruptive companies. Look for those which are going to survive and thrive even with lower labor. Anyway, that wraps up today. If you missed any of this, you'll find within a few days a blog on the website, adamsfinancialconcepts.com. Have a very good week, a good weekend, and I will be back next Saturday with more.
About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts. The following program is sponsored